$8 billion. That is how much the United States adds to its debt every single day. The scale is 8 and the pace is daily. Today, the ledger reads $38 trillion, but hardly anyone can explain what that number truly means for the future of the United States. Interest payments now outpace Medicare, political gridlock rules out easy fixes, and beneath the headlines, the options narrow with every tick of the clock. What happens when a country famous for creating money runs out of time? The real math behind the $38 trillion trap begins here. The Treasury's own ledger splits America's $38.43 trillion debt into two stark columns. About $30.74 trillion sits in the open, held by investors, pension funds, foreign governments, and the Federal Reserve. These are the marketable treasuries, bills, notes, and bonds traded daily from Tokyo to London to Wall Street. The rest, $7.69 trillion, is hidden in plain sight, owed by the government to itself. Social Security and Medicare trust funds, by law, must buy special issue treasuries, creating a closed loop where one arm of government lends to another. These internal IOUs are backed not by assets, but by the promise of future taxes. Yet even this headline number is only the start. Economists like Lawrence Kotlikoff warn that the real fiscal gap is far larger once unfunded promises for Social Security and Medicare are counted. By his accounting, the true liability, future obligations minus expected taxes, could exceed $200 trillion. The official number, $38 trillion, is simply what is visible on the books today. To put the scale in perspective, if you stacked $100 bills equal to the federal debt, the pile would circle the earth 15 times. Interest alone is nearing $1 trillion a year, outpacing Medicare and swallowing 18% of federal revenue. Debt now matches the size of the entire United States economy, with debt to GDP at 100%. Most Americans, regardless of party, say they want lawmakers to treat this as a top priority. But what exactly does this number mean for the future? Even experts cannot agree where the line between manageable and catastrophic truly lies. Olivier Blanchard's debt dynamics equation transforms the U.S. balance sheet from a static snapshot into a ticking engine. The math is blunt. Each year's debt becomes next year's burden, multiplied by whatever interest rate the market demands. In fiscal year 2025, the government is already running a primary deficit of $1.8 trillion, spending that much more than it collects before even counting interest. At today's average coupon of 3.35%, the cost to service existing debt is climbing faster than the economy itself. If rates rise just 1 percentage point above projected levels, the Congressional Budget Office estimates over $2 trillion in extra interest over a decade. The compounding effect means every new dollar borrowed adds not just to the principal, but to the interest bill, which then must be paid by even more borrowing. Blanchard's formula says debt tomorrow equals debt today, times the ratio of interest to growth plus the new deficit. And it shows how small changes can tip the entire system. If economic growth outpaces borrowing costs, the spiral can slow or even stabilize. But if rates stay high or deficits persist, the numbers accelerate. Under baseline projections, debt to GDP is set to reach 117% by 2034. In a high-rate scenario, it could breach 150% in just over a decade, as interest compounds on itself. The difference between stability and escalation hinges on fractions of a percentage point. For policymakers, the margin for error is vanishingly thin. Each uptick in rates or slip in growth pushes the U.S. closer to a cliff where the debt feeds on itself, leaving fewer and fewer options to regain control. Austerity runs headlong into the realities of American politics and law. The Congressional Budget Office warns that slashing spending or hiking taxes fast enough to stabilize debt at 100% of GDP would risk recession. No major party has been willing to propose cuts on that scale, and public backlash has stopped every attempt at sweeping entitlement reform. In 2011, even a bipartisan deficit commission's plan collapsed before reaching Congress. The Committee for a Responsible Federal Budget cautions that without drastic action, some form of crisis is inevitable, but the political will for true austerity simply does not exist. Default, the other supposed exit, is not just unlikely, it is illegal. The 14th Amendment says the validity of the public debt of the United States shall not be questioned. No president or Treasury Secretary has ever dared to test this line. The closest the United States has come was in 1979, when a technical glitch delayed Treasury bill payments by just a few days. Markets panicked, interest rates on short-term debt jumped by 60 basis points, and the episode is still cited as a cautionary tale in central banking circles. Unlike Argentina or Russia, the United States cannot legally walk away from its obligations without triggering a constitutional crisis. Economist Stephanie Kelton, a leading voice for modern monetary theory, stands nearly alone in arguing that fiscal space is far larger than mainstream models suggest. For most policymakers and market participants, though, the exits are closing. With austerity and default both off the table, only one path remains, and that path comes with deep uncertainty. Inflation works quietly, erasing debt not with a crash, but with a slow, relentless math. At 2% inflation, the real value of a fixed debt like $38 trillion halves in about 35 years. If inflation runs at 6%, the same debt shrinks by half in just 12 years. The formula is simple. Real value equals nominal value divided by 1 plus the inflation rate to the power of years. A government facing mounting bills can let prices rise, and over time, the burden fades, even as the numbers on the Treasury's books barely change. After World War II, the United States owed more than the value of its entire economy. By the early 1970s, that debt had dropped to 1/3 of GDP. The trick was not mass repayment, but years of 4 to 5% inflation, compounded by growth. Savers who bought bonds in 1946 watched their purchasing power erode by 80% over the next 3 decades. The government paid every coupon, but each dollar bought less bread, less rent, less of anything that mattered. Ruth Eisenstadt, a retired school teacher in her 80s, still keeps her father's war bonds in a drawer. He bought them in 1945, proud to help rebuild the country. The bonds paid 2.5% interest, but inflation in the 1950s and the 1960s quietly devoured their value. By the time Ruth cashed them in, the money covered a fraction of what it once could. For Ruth and millions like her, the silent eraser shifted the cost of national recovery onto those who trusted the promise of a fixed return. At modest inflation rates, the pain is gradual, a distant problem for future retirees and bondholders. But when inflation climbs higher, the process accelerates and the losses become impossible to ignore. The arithmetic does not discriminate. It rewards debtors, especially governments, and punishes those who save in dollars. The tool is seductive. No votes, no headlines, just a quiet transfer of wealth from creditors to the state. Yet history warns that the price of using inflation as an eraser is never shared equally. Social Security's trust funds hold $2.8 trillion in special issue Treasury securities, a sum locked in by federal law. Section 401 of the Social Security Act directs every surplus dollar into government bonds, forbidding outside investments. This is not a choice made by fund managers. It is a statutory requirement enforced since the 1930s to guarantee that America's retirement savings help finance the federal deficit. The trust funds receive a fixed interest rate, often below what private markets might offer. And when benefits come due, the Treasury must redeem those bonds, usually by raising taxes or issuing new debt to the public. The same principle shapes private sector pensions, though the rules are less explicit. Under the Employee Retirement Income Security Act, fiduciaries are bound by a duty of prudence and diversification. In practice, this means pension plans, especially giants like CalPERS with $500 billion under management, channel a significant share of their assets into United States treasuries. CalPERS's latest filings show about 20% of its portfolio in government bonds, a pattern repeated across most large defined benefit plans. These allocations are not set by law, but by the constant threat of lawsuits and regulatory scrutiny. The Department of Labor's guidance warns against imprudent risk, making treasuries the default safe harbor for liability-driven investing. Alicia Manel, director of the Center for Retirement Research, describes this system as a structural demand engine. Every month, pension contributions and Social Security surpluses flow into treasuries, providing a captive source of funding for the federal government. According to Government Accountability Office estimates, pensions and trust funds together absorb 10 to 15% of all new Treasury issuance each year. This steady demand keeps borrowing costs lower than they might otherwise be, even as the overall debt climbs. Yet the arrangement is not without controversy. Critics argue that these legal and regulatory constraints create an artificial market, masking the true cost of federal borrowing. They warn that as the population ages and trust funds begin to draw down, the government will lose its most reliable buyer, forcing the Treasury to compete for funds in global markets. For now, the law ensures that American workers, through their retirement savings, remain involuntary financiers of the national debt. In the 1990s, a quiet transformation took place inside the Bureau of Labor Statistics. The Consumer Price Index, America's main yardstick for inflation, underwent a series of technical rewrites that still spark debate among economists and historians. The BLS Handbook, Chapter 17, spells out the changes. Geometric chaining replaced arithmetic means, letting the index account for consumers swapping steak for chicken when prices jump. This substitution bias, intended to reflect real-world choices, trims the reported inflation rate by up to 0.5 percentage point each year. Quality adjustments known as hedonic regression followed soon after. When a new smartphone costs more but comes with a better camera, the BLS now estimates how much of the higher price is pure inflation and how much is genuine improvement. The result is that a portion of rising costs disappears from the official numbers, attributed to better features rather than higher prices. Nowhere is this more controversial than in shelter costs. Instead of tracking actual rents paid, the index relies on owners' equivalent rent, a survey asking homeowners what they think their house would rent for. This single category now makes up over 30% of the CPI basket, amplifying any distortion. Erica Groshen, former BLS commissioner, defends these methods as essential for accuracy in a changing economy. Critics like John Williams of ShadowStats argue that these tweaks systematically understate the true rise in living costs by as much as 3 to 7 percentage points, depending on the year. The gap between official inflation and everyday experience leaves savers, retirees, and wage earners questioning whether the compass guiding economic policy still points north. As the debate rages on, the yardstick itself has become part of the story. In the aftermath of the 2008 crisis, the Federal Reserve's balance sheet expanded at a pace that would have been unthinkable just a decade earlier. By 2022, it peaked near $9 trillion, a sum that included more than 1/5 of all outstanding Treasury securities. The Fed's emergency programs, launched to stabilize markets, became the main engine for financing federal deficits, buying up bonds as quickly as the Treasury could issue them. Yield curve control, once a tool of wartime necessity, returned in a new form. Explicit or not, the Fed's actions kept long-term rates pinned far below the pace of inflation. Archival footage of Ben Bernanke addressing Congress in 2011 captures the moment he said they were working closely with the Treasury to ensure smooth market functioning. Behind the scenes, coordination blurred the traditional lines between fiscal and monetary policy. During the COVID-19 shock, the Fed purchased $1.6 trillion in treasuries in just a few months, absorbing a historic wave of new issuance. At times, the central bank owned a quarter of all marketable U.S. debt, an arrangement that once would have been called fiscal dominance. The precedent is not new. In the 1940s, the Fed capped Treasury yields at 2.5% for almost a decade, buying unlimited bonds to keep government borrowing costs low. Inflation surged to 19% before the Accord of 1951 restored central bank independence. Today, with debt at $38 trillion and annual deficits measured in trillions, the question is no longer whether the Fed will accommodate the Treasury, it is whether it has any real alternative. Each new round of bond buying pushes the central bank deeper into fiscal territory, raising doubts about the limits of monetary policy when the government's need to borrow becomes the dominant force. When the Federal Reserve creates new money, the first stop is not Main Street. It is the primary dealers, major banks and asset managers who buy treasuries directly from the government. From there, fresh dollars flow into financial markets, bidding up stocks, bonds, and real estate. Economist Gabriel Zucman points to the aftermath of quantitative easing. Between 2009 and 2022, the top 1% of Americans saw their wealth jump by over 20%, closely tracking the Federal Reserve's expanding balance sheet. The mechanism is simple but powerful. When the Fed buys bonds from banks, those institutions gain reserves they can use to make loans or invest in riskier assets. As asset prices rise, the wealthiest households, who own the majority of stocks and bonds, capture most of the gains. Flow of funds data from the Federal Reserve confirms this pattern. Each round of monetary stimulus disproportionately benefits those closest to the source. The result is a distributional skew that deepens inequality, even as the stated goal is economic stability. For millions of Americans, wages and savings lag behind. For a select few, new money arrives early and multiplies. Gabriel Zucman calls this the Cantillon effect, a system where the rich get richer, not by accident, but by design. Savings that once seemed untouchable now erode in plain sight. $100,000 left in cash at 4% inflation loses half its purchasing power in just 18 years. Even Treasury inflation-protected securities TIPS offer little refuge. Their share of the federal debt sits below 10%, and their payouts are tied to the official Consumer Price Index, known as CPI, that many argue understates real inflation. For most savers, the promise of safety has become a slow-motion loss. The search for a true safe haven is growing harder. At the frontier of money, new technology threatens to close the last escape routes. In China, the ECNY pilot has rolled out digital cash with programmable features, spending limits, merchant restrictions, even built-in expiration dates. The People's Bank of China can direct stimulus to certain sectors, or make money vanish if it is not spent quickly. More than 260 million digital wallets have been opened since 2020, all with rules enforced by code. Eswar Prasad, an expert on digital currencies, warns that central bank digital money could make policy enforcement absolute. In the US, the Federal Reserve has studied similar designs, with technical papers showing how a digital dollar could support conditional payments or expiration. No such system is live yet, but the tools exist. The lesson from abroad is clear. When money itself can be programmed, the freedom to save or spend on your own terms is no longer guaranteed. Today, interest on America's debt rivals entire federal programs, yet the numbers keep climbing, unseen but relentless. As every pension fund, savings account, and digital dollar becomes part of this equation, the stakes are no longer abstract. The system is not just a policy debate, it is a lived reality for millions. In the end, the trap is not the debt, it is believing there is no consequence. Share your perspective below.